Figures released this week show the Spanish economy shrank again in the first 3 months of the year, making it 7 consecutive quarters in decline. And although government borrowing costs have fallen, bank credit remains scarce for corporates of all sizes. The Bank of Spain has compounded the negative sentiment, stating it expects no growth until 2014. I'm joined by Virginia Garcia Martinez, Head of Leisure, Retail and Consumer Coverage at mergermarket, to discuss what type of M&A market these macro challenges are creating. Virginia, no doubt it's been a difficult picture for the past couple of years in Spain. Can you give us an idea as to the story so far this year?
You've just pointed it out very clearly. The macroeconomic environment is definitely painting a bleak picture of low growth and high unemployment, and that's also reflected in terms of M&A activity. So if you look at what has happened during 2012, the first half of the year was actually quite positive. There were quite a few deals that were being completed, numbers were looking more or less good, but then in the second half all of that started to decline. So the number of transactions that were closed in the second half of 2012 was reduced quite substantially, and this downward trend has actually continued into 2013. So what we've seen in this first quarter of the year is that activity has actually been quite quiet. Just to give you some figures to illustrate this point, merger market data says that in the first quarter of the year, the total number of deals that were closed amounted to 3.4 billion euros. Which is actually almost a 60% drop compared to the same period of 2012. And this has actually been the worst quarter since 2004. So, the situation is clearly not looking very promising at this stage of the year.
And what kind of pressures are those macro issues putting on deal makers trying to facilitate M&A transactions?
Well, what we're seeing is that deals are quite difficult to close at this stage, and it's mainly because it's still quite difficult to have access to financing, and mainly because international investors are still not coming into the region in big numbers. So again, referring to some data by mergermarket, the total number of foreign investment that came into the region in the first quarter was actually almost 70% less than in 2012. And this has actually been the lowest in 11 years. So, clearly what we're seeing here is that if investors, are not willing to come and take the risk, even though prices have gone down, but, if they see that, okay, we have these assets, but they carry, a certain amount of debt. So at the end, the numbers don't add up, and many investors are not really willing to take that risk.
And are there any examples in particular that have found it challenging to complete?
As I said, there are a number of assets that, have been in the market for a while. I can think of a couple of examples. For example, there is the coffee chain Café Té and the consulting group Everis. 3i has invested in both of these companies. And in the second half of last year, both of them, came to market. And for example, in the case of Everis, it's a really attractive asset. It has, an important presence globally, and they still have really good prospects in terms of international growth. But even though it has attracted a lot of interest from both investors in the US and Asia, a deal hasn't been completed yet. So this is just a good example that illustrates what's happening at the moment in the country. So there are lots of assets and opportunities out there, and that's mainly been driven as well by banks. So you have lots of banks that are going to be looking to do aggressive disposals of non-core assets as a way to deleverage their balance sheets. So there's going to be lots of opportunities in that respect, lots of sales of non-controlling stakes, both in listed and unlisted companies, and we'll continue to see also restructuring processes. So the opportunities are out there. The pipeline is looking quite good. The problem is again that, on the other hand, you have all of these international investors that are being really cautious. They are, thinking twice before, going and putting in the money. And also, when you look at the local private equity funds, they are running out of money. They are struggling to raise more funds. And in the end, you have a situation where you just think, okay, great assets, some of them, and, all of these opportunities in the market, but, where are the buyers and where are they going to come from?
And are there any particular deals in the pipeline, any particular names we should be looking out for?
Well, I mean, there are a few interesting situations in the financial services sector, which, as you know, has been pretty active in the last year or so, because there's been a wave of consolidation among the savings banks. So even though that has pretty much been completed, there are still a few assets that will have to be sold. And for example, you know, one of I suppose the main names is Bankia. There's also been an interesting deal happening quite recently with NH Hotels, the hotel chain. They recently sold a 20% stake to a Chinese group, H&A, and they also signed an agreement with a US investment fund. But again, this is an asset that, you know, is in the hands, well, there is a stake that is in the hands of a group of banks, and again, they're going to be looking to sell at some point. So, you know, that's another company that, you know, we should be keeping an eye on, and, you know, there could be more developments in the future. But I mean, I would think that 2013 will probably be dominated by fire sales. So, you know, what we're going to see is sellers looking to probably, you know, offer deep discounts as a way of, you know, tempting and attracting, you know, these investors into a market that, you know, has been suffering for a while.